Let's go ahead and bring in CNBC senior economics reporter Steve Liesman for all the headlines. He joins us from Jackson Hole, perhaps the most important man of the day next to Jerome Powell. Steve, thanks so much for being here with us. I know you've had a really full day, but there's no one better to talk to than you about all of this. And Bonawyn brought up a great point with some of the words, and words mean everything, especially when they come out of the chairman's mouth. Words like pain. How much pain economically is Chair Powell willing to take on to keep inflation lower? What level of joblessness, what level of depressed economic growth would be okay?
I don't think we know. It's something we're going to have to figure out over time. But what is, I think, clear is a couple weeks ago at the press conference, I asked Chair Powell how a recession would change your policy, if at all. And he really didn't answer the question. I asked it again. He didn't answer it. He kind of answered it today, and he said at least some level of pain, some level of contraction of the economy, some level of a rise in unemployment would not dissuade the Federal Reserve from either hiking rates, depending upon where it was, or keeping them at a certain level. Courtney, I got to say I'm a little angry. I'm angry at the market today. I'm angry at maybe Tim, maybe Bonawyn, maybe Grasso. I mean, I don't mean them specifically, obviously, but what were you guys thinking? I mean, how much Fed talk about higher for longer? How many times did the Fed have to say, we are not going to raise rates only to cut them immediately? It was like the Fed said blue and the market said no, yellow. And the Fed said blue and the market said yellow. And then we had three guys here, Bostic and Esther George and Patrick Harker. Harker and Bostic, they're not hawks. These are some of the most dovish people you out there telling me 3.5%, 4%. No raise and then cut. We're going to hike and hold. And we kept saying it. I led my story this morning with you can expect Powell to say higher for longer. And the market, I don't know. Who are these guys that went in long? I'm just a little angry that folks didn't protect themselves today and hear what people were saying and decided to hear their own story or what they wanted to hear from the Fed, even though the Fed wasn't saying it.
Well, Steve, but this is a market that's been inured on the Fed always being there for them. And frankly, I brought up at the top of the show, I commend Powell on being very clear, but this is a guy that's been very much criticized for sending mixed messages. So the pain part of this, my question to you, though, comes from we didn't really talk about the job market and going after.
Tim, I'm not mad at you. Tim, just to be clear, I'm not mad at you. Tim, I'm not mad at you. Just to be clear.
I appreciate that because we go too far back, Steve. But the pain on Main Street, and this is why this is why it's an important day and why I think there's a lot of anxiety. I think there needs to be a focus on the job market. That's going to be painful. That's where the term pain comes in. We had a PCE number that came in today that actually showed that labor income is actually growing and that you actually have strength, at least in one of the most inflationary underlying and stickiest parts of the economy.
Yeah, and that's important. Remember, Powell's message so far has been we can kind of get away with this perhaps by reducing job openings, not necessarily actual jobs. And he's kind of saying, we may have to reduce actual jobs here. There is some question, Tim, about how much jobs or unemployment has to rise in order to solve the inflation problem. I have this crazy idea that putting people back to work may help solve the inflation problem, in part because so many industries are still short of workers, even while the economy is larger. But be that as it may, what the Fed chairman is saying, a couple ways to think about this. You remember that old phrase, the beatings will continue till morale improves. Well, the rate hikes are going to continue until inflation improves. And I think Powell thought, I guess correctly, that there was some misunderstanding about where he stood. Go back to that press conference. I'll tell you a little inside reporting story, which is that when the press conference was over and the reporters who were in the room looked at the market and saw that it was up, I forget how many points, 400 or 500 points, and there's this talk about pivot, we all turned ourselves and say, what did they hear that we didn't hear? We didn't hear the pivot back then. There was this comment, and by the way, he said it again, that it may be appropriate at some time to slow the pace of rate increases. Well, of course, that's really obvious. It really was never any doubt about that. They may do 75, they may go down to 50, they go down to 25. That doesn't mean they're going to stop the rate hikes. It also doesn't mean they're going to start cutting as soon as they hit a peak rate.
That's true. At some point, it may happen. It just may be years down the road. Steve, before we let you go, I know you're very busy and you've got a special to prepare for here coming up. And forgive me if this seems like kind of a sophomore question, but why is PCE such an important data point? Removing food and energy Aren't those two pretty important pieces of inflation, things we can't avoid as consumers? And if we're paying more for that, then my gosh, it's going to depress what we have available to spend on other things. Why do we put so much emphasis on an ex-food and energy number?
Courtney, never any sophomore questions for you, only graduate level, it seems to me, and that's a good question. Let me tell you a couple things. First of all, what they do is they go back, there's research that shows when you get rid of some of the noisy parts of the data, and there are different ways of doing this, removing food and energy is one way to do it, is that you have a better guide for guiding policy. If something goes like this every month or every couple months, it's not a really good way to set policy, which, as you know, according to the saying, has a long and variable lag. So it may be up 1 month, down 1 month. So you try to remove some of the noise. There's other ways to do that. For example, there's a trim mean that takes out whatever is really high or really low in a month. So that's one aspect of it. The other aspect of it is the PCE, rather than the CPI, has a different sort of configuration that is a little more stable and less up and down than the CPI. So that's why they go with the PCE, certain configurations and weightings in there that the Fed has tended to prefer more. The question you ask yourself is, okay, if oil is up, you know, to $100 1 month and down to 50 another month, should you be changing policy as a result of that? And the answer over time, according to the research about the best way to set policy, is no. You want to look at the core. And by the way, one other quick thing is that's the thing that really spooked the Fed. It wasn't the high energy and food prices. It was when it bled into the core. And we talked to George the other day. She said, you know, there's this that's down and that's down, but it seems to be still widespread. And not until she sees several months of declining inflation will she be confident that maybe they can reverse policy or at least stop the big rate hikes.
Perfect. I knew you had an answer for me. I feel better. I feel like I understand it more. Steve, thank you so much. Thanks for spending time with us. We will see you at the top of the hour on the CNBC special, The Fed Factor. But while I have the folks still with me here, gentlemen, let's trade this. Steve, since Mr. Liesman took a little bit of a poke at you as a trader, I'm going to let you give a reaction here for what he had to say.
Yeah, I don't think he took a poke at me, but I get what you're saying. I think what he's missing, though, is that traders act on whatever the market gives them that day around their core positions. So and by the way, I heard Harker say basically that they'll stay at a certain level, 3.5%, and then they'll sit and wait to see if inflation drops, and then they can be more accommodative. So I didn't hear that they're just going to stay that way and be robotic, or else they're running on a script and not running on data. Once again, I'll just tie it up with this, Court. No one's talking about quantitative tightening again. We're doubling in September. There's going to be $100 billion rolling off, so that's tightening as well. So I think we'll see 75 basis points in September, probably create a little more volatility in the markets, and then I think you're going to see a little bit softer, or not a pivot, but they'll stay the course. And I think ahead of those elections or at the elections, we're going to have a nice rally going into year end.